Hello, and welcome to the Banker's Tech Talk video series, looking at all things fintech. We've been going for about 5 years now, and you can see all previous episodes on thebanker.com/techtalks. I'm Joy Macknight, managing editor of The Banker, and my guest this week is Marina Goche, who is CEO of Sentifi, which is an alternative data provider for banks and institutional investors. Marina, thanks so much for joining me.
Thank you, Joy. A pleasure to be with you.
So Marina, how are markets and portfolio analytics being used really to help the sell side market participants generate alpha and manage risk?
Well, Joy, what we're seeing is that the landscape really for data and the data sets that can be applied to make alpha generating and risk management decisions is changing. So the market participants who are really embracing that change in the sense that they are adopting not just traditional financial data sets like economic data and securities pricing data, but they're also embracing investment signals from the likes of Twitter, news, and blogs, for example, which is what Sentifi focuses on, are really starting to augment the traditional alpha generating decision-making process. It's really possible today, real time, through social media, news, and blogs, to look for outliers in a way that it hasn't been previously with traditional financial data sets. So what we're seeing is institutional investors that really embrace commingling both data sets to derive investment signals and applying those signals to generate alpha and manage risk. They're really outperforming their peers.
So how can you use machine learning and artificial intelligence really to drive this forward?
Mm-hmm. Well, machine learning technologies really have are having a transformation in the industry. So machine learning, we find, correctly applied, can help digest large volumes of data real time. And that's important in investment decision making, clearly, because you're looking for that edge, that insight that's really going to help you make effective portfolio rebalancing, decisions real time. And so what we find with machine learning is that the models are helpful to digest large volumes of data. They're helpful to recognize patterns in the data sets. If there are abnormal shifts in sentiment, for example, for a particular asset, machine learning models can quickly surface that. They can also help time, market entry and exit decisions. So, for example, we jointly with one of our customers built a machine learning model to time entry and exit into the S&P 500. And what we found with that exercise is that we were able to develop that model in a fraction of the time that it ordinarily would have been had we not applied, machine learning technologies. So in many ways, the power of the technology is there. It needs to be applied correctly. The models, of course, need to be trained to deliver the results that you're looking for. And therefore, it's very much still human judgment that drives the efficiency of that technology set.
Okay, my next question is around ESG, environment and social governance criteria. How are ESG scores and what's called event materiality being used today and in driving investment decisions?
So what ESG scores mean for our customers tends to vary quite dramatically. So we see customers who have relied on traditional ESG scores, which are based on corporate filings and sustainability reports, which are often out of date by the time they're published, right? And so when they come to us, they're looking for unbiased methodologies which provide a true view of the perception of ESG performance appreciation or degradation for a stock. And so in that context, Sentifi, for example, provides a real-time ESG score, which really is a view of all of the ESG events that have been reported in Twitter news and blogs for a particular asset from credible sources of intelligence. So we verify the source, and then we make sense of it. So we say, is this particular ESG event more significant for the stock today than previously? Is it more significant than peers in the industry or the sector? And so in that context, materiality is not a static state, it's a dynamic state, right? So when we look, for example, at healthcare stocks this year, clearly the vaccine development progress, and more importantly, how materials are sourced for the vaccine development and the logistics of distribution of the vaccine is material for stocks in the healthcare sector. And in a way that, previously that was not, material sourcing and efficiency was not a factor that was considered material for healthcare. So it's a very much a dynamic, evolving state. And what we help our customers understand is how this is shaping the perception of ESG performance of a particular stock, and also how that perception is likely to impact the stock price. Because fundamentally, that's what our clients are looking for.
Excellent. Well, thank you so much for your insights, Marina.